You might think the stock market is simple. Buy low, sell high, and profit. But if it were really that easy, millions of beginners wouldn't lose money every single year. Most beginners lose money not because the market is unfair, but because they make predictable mistakes that wipe out capital and confidence long before they ever see consistent gains. And the worst part? Most of these mistakes are invisible until the damage is already done. Today, we'll break down exactly why beginners lose money, illustrate it with real cases and data, and most importantly, show you how to avoid these traps so you can invest with confidence and discipline. Let's begin by understanding the core issue that kills most new investors' returns. Let's start with the most dangerous category of all mindset mistakes. The mindset mistakes that cost you money. If you think investing is a quick way to get rich, you're setting yourself up for losses before your first trade. 1. Expecting quick riches. Many beginners see screenshots on social media of people turning small amounts into huge money and think the same will happen to them. This ultra-shorter mindset treats investing like gambling, not like owning parts of profitable businesses. The stock market historically averages around 10% annual returns, but it never moves in a straight line. Real growth takes time, discipline, and patience, not quick flips. Warren Buffett once joked that the market is a device for transferring money from the impatient to the patient. Beginners who expect fast profits are more likely to panic sell during normal volatility. 2. Emotional investing. Fear and greed. One of the most cited reasons beginners lose money is emotional decision-making. Here's the brutal truth about markets. Fear makes investors sell during dips. Greed pushes them to buy at peaks. Behavioral finance research shows that loss aversion and FOMO, fear of missing out, are primary psychological traps for beginners. Writing down your reasons for a trade and sticking to a process helps prevent emotional decisions. 3. Lack of education and research. Dive into the market without understanding what you're buying and you're essentially guessing. Many beginners invest based on tips from friends, random social media influencers, or rumors. They rarely analyze earnings, balance sheets, or competitive position. A 2019 survey found fewer than half of new investors are even confident in their basic financial knowledge, creating a systematic disadvantage. This mindset leads to the next major category of mistakes: strategy errors. Mindset errors set the stage, but it's the strategy mistakes that often kill a portfolio. Common strategic errors. No strategy equals no success in markets. Professionals don't trade aimlessly, and beginners shouldn't either. 1. Trading without a clear plan. Beginners often enter the market without defining entry and exit rules, risk limits, or goals. A professional approach begins with a plan. Why am I investing? What is my timeline? When will I sell? Without this, every price movement feels like a crisis or an opportunity, and emotional reactions take over. 2. Trying to time the market. Trying to time buying at the lowest point and selling at the highest sounds logical, but it rarely works in practice. Missing just the 10 best market days over a long period can cut decades of gains in half. Market timing tends to lead beginners to buy high and sell low, the opposite of what makes money. 3. Overtrading. Activity not equals profit. Many beginners believe that frequent trading creates more profits. The reality is the opposite. Overtrading increases fees, taxes, and errors. Constant buying and selling often results from anxiety or boredom rather than proper signals. Studies of new traders show that those who trade less and stick to a plan often perform better. 4. Chasing hype stocks. History is full of examples where retail investors jumped into trending stocks without understanding risk. The GameStop situation of 2021 saw the stock surge from under $20 to over $480, largely driven by retail fervor. When the frenzy faded, the stock collapsed over 60%, costing many latecomers severe losses. The lesson here is clear. Buying hype without fundamentals is gambling. not investing. Understanding strategy mistakes is critical, but losing money often boils down to poor risk management. Risk and money management errors. You can be right about a stock but still lose money if you ignore risk. 1. Ignoring diversification. Putting all your capital into one stock or one sector dramatically increases risk. If that investment drops, so does your entire portfolio. Diversifying across industries and asset classes spreads risk and stabilizes returns over time. Diversification doesn't eliminate risk, but it does protect you from catastrophic losses if a single company or sector falters. 2. No stop-loss or risk rules. Many beginners refuse to set stop-loss orders, assuming a stock will eventually rebound. When markets move against them, losses grow unchecked. A disciplined approach limits risk per trade to a small percentage of the portfolio and uses stop-losses to protect capital. 3. Trading with borrowed money or leverage. Some investors borrow money to trade, magnifying both gains and losses. Margin trading forces liquidation during downturns, often at the worst prices, and is one of the fastest ways to destroy a portfolio before gaining experience. Good risk management is not optional, it's essential for survival. Even with strategy and risk controls, psychology still influences outcomes. Psychological traps that destroy portfolios. Your worst enemy in investing isn't the market, it's your own mind. 1. Anchoring on past prices. Beginners often believe a stock falling from a high price is cheap, anchoring to past values that have no bearing on future performance. Investment decisions should be based on present value and fundamentals rather than past peaks or valleys. 2. Overconfidence after early wins. A few good trades can create a false sense of mastery. Overconfidence leads to bigger positions and bigger risks. Professional investors remain disciplined regardless of recent performance. 3. The market math trap. A critical but overlooked concept is that losses require larger gains to recover. For example, a 20% loss needs a 25% gain just to break even. This simple mathematical reality can catch beginners unprepared. Understanding this encourages disciplined risk control instead of hoping for quick recoveries. Now that we've seen what causes losses, let's turn to how beginners can avoid them and succeed. How to avoid losing money and build real returns. Avoiding mistakes is half the battle. Adopting proven strategies is how you win consistently. 1. Think long-term. The market rewards patience. Long-term investors who stay through market cycles benefit from compounding and reduced emotional stress. Short-term volatility becomes less important when your horizon is decades, not weeks or months. 2. Dollar cost averaging. Investing a fixed amount regularly, regardless of price, reduces the risk of bad timing and smooths out market volatility. This technique builds discipline and avoids emotional entries. 3. Educate yourself. Spend time learning, not just reacting to tips. Study financial reports, valuation metrics, and risk management techniques. Knowledge allows you to separate facts from noise, making decisions based on reason rather than emotion. 4. Start with diversified investments. For beginners, broad market funds like index ETFs can be safer and more effective than picking individual stocks. They offer built-in diversification and reduce single-stock risk. 5. Use a decision journal. Write down why you made each trade, what you expected, and how you felt at the time. Reviewing this sheet regularly reveals personal biases and habitual errors, a powerful self-correction tool. The stock market isn't designed to make beginners rich overnight. It's designed to reward discipline, patience, and strategy. Most investors lose money because they act impulsively, lack an evidence-based strategy, and ignore risk management. If you apply the principles we've discussed, focus on long-term thinking, control emotions, diversify, and educate yourself, you can avoid the traps that destroy new investors and build lasting financial success. If you found this video valuable, like it, comment on one mistake you once made or want to avoid, and subscribe for more deep, fact-driven financial insights.